Elon Musk is preparing to take SpaceX public at a target valuation of $1.75 trillion. At that price, the company would be worth more than Coca-Cola, McDonald's, Disney, Nike, and Starbucks combined. Yet the numbers in the filing tell a different story. Last year, the aerospace giant recorded a net loss of nearly $5 billion. That contrast raises a question. Why pay the highest initial price in human history for a company currently losing money at that scale? The buyers are ordinary Americans. Within weeks of the listing, standard retirement accounts and 401ks will be the primary source of demand for these shares. This isn't an accident. It is the result of a quiet shift in the rules that govern how companies enter the stock market. The SpaceX IPO is designed to use the steady, automatic flow of passive retirement savings to provide an exit for the company's private owners. The public perception of SpaceX is built on its launch success. Retail investors see reusable rockets and a satellite internet business that, on its own, is genuinely profitable. But the company being sold to the public changed in February 2026. SpaceX completed an all-stock acquisition of xAI, a separate artificial intelligence venture founded by Musk. The AI subsidiary was losing over $1 billion a month. Its founding team of researchers had already walked out, leaving behind a $16 billion mountain of debt. SpaceX secured a $20 billion bridge loan to refinance that AI debt onto its own balance sheet. This shifted the financial liability from Musk's private ventures directly onto the ledger public shareholders will now fund. Instead of funding a colony on Mars, the capital raised from this IPO will be used to bail out Musk's social media and AI projects. To enter major stock indexes, a company must usually prove it is profitable. It's a regulatory hurdle designed to keep speculative, money-losing firms out of stable retirement funds. SpaceX reached that milestone just before the IPO by signing a contract with Google, who agreed to pay $920 million per month for access to computer capacity. But deep in the filing, there is a catch. After December 2026, either company can cancel that entire commitment with just 90 days' notice. The profitability being shown to the public is a temporary accounting maneuver, built on a contract that can vanish shortly after the shares are sold. For retail buyers, the math is punishing. Public investors are putting up 48% of all the capital the company has ever raised, but they will receive just 4.2% of the shares in return. The earnings are a mirage, designed to secure index inclusion and trap passive investors before the revenue evaporates. Passive investing is vulnerable because it is automatic. When the 15-day window opens, trillions of dollars in passive funds will be forced to buy that tiny supply, regardless of how high the price has been pushed. Traditional market protections weren't just ignored. The rules were rewritten to ensure retirement accounts buy at the absolute peak of an engineered spike. The exit strategy is already in place. Insiders and early venture capital investors have a scheduled system to sell their shares at the exact same time the index funds are forced to buy. New buyers will have no say in how the company is run. Musk retains 85% of the voting power, and the corporate charter effectively prevents public shareholders from suing. Major public pension funds have already identified the risk. They are formally protesting the offering, warning that it removes the accountability that keeps public markets safe. Once the insiders have finished selling and the 90-day Google contract is canceled, the artificial demand will disappear, leaving 401ks holding the losses. This IPO sets a new standard. If this structure succeeds, it becomes a blueprint for other billionaires to offload their private debts onto the public. It requires investors to look more closely at their index funds and reconsider the risks of a set-it-and-forget-it strategy. The SpaceX IPO marks a shift in the public markets, a legal framework that allows the costs of billionaire failures to be transferred directly to the American working class.